All right. Excited to be here with my fellow revolutionaries of the digital asset treasury revolution. Very excited to be here. My name is Xiao-Xiao. I'm going to be moderating the hopefully fascinating conversation. I'm operating partner at KKR. KKR is the biggest private investment firm in the world with about 700 billion AUM. I have been leading the digital asset strategy at KKR alongside tech, private equity, value creation. I'm going to hand it over to Joe.
Hi, I'm Joseph Shalom. I'm the CEO of SharpLink Gaming. We are the second largest ETH treasury in the world with about 3.5 billion of ETH under management for investors, the fourth largest treasury globally. And I joined just a couple of months ago after 20 years at BlackRock, where for the last 5 years led all digital asset efforts across stablecoins, tokenization, and the launch of the largest ETFs in history, which were on Bitcoin and ETH.
Morning, everyone. My name's Andrew Webley. I'm the CEO and the founder of the Smarter Web Company. We're a UK-listed business. We're the largest Bitcoin treasury company in the UK, bigger than all of the other ones in the UK added together. We're probably in the top 30 Bitcoin treasury companies in the world by number of Bitcoin held. I founded the business 15 years ago, a small technology business, then listed it on the stock market in April this year. And that's taken us to the point at which we're today where, we own approximately $300 million US dollars of Bitcoin.
Thanks. David Schamis. I will be the CEO of Hyperliquid Strategies when our deal closes, hopefully not too long from now. We will be the largest hype digital asset treasury company out there by far. We raised approximately $900 million in both kind and in cash. Expect the deal to close sometime in the fourth quarter. My day job is that I'm one of the co-founders of Atlas Merchant Capital, private equity firm focused on financial services. My co-founder is Bob Diamond, the former CEO of Barclays.
Fascinating. So just to set the stage maybe a little bit, I think the whole landscape of institutional investing, so not crypto native investing into digital assets, has undergone a tremendous change over the last couple of years, right? Like when we got started at KKR at looking at potential larger scale investments into the space, there was not really like other vehicles, right? The game in town was essentially crypto VC or crypto private equity investing. And I think the peak in terms of VC investing in crypto was really 21. If you look at the number today, I think 25, we have cumulatively about 8 to 10 billion of crypto VC investments, which is probably a third or a fourth of what it was in 21. What has come instead is, and Joe will know that a lot, is ETFs, right? ETFs started in the last 2 years. We were one of the pioneers in that space. And 25, if I'm correct, the estimation is about 60 billion of net inflows of total ETFs into sort of Bitcoin and related digital assets. And what is completely new this year are digital asset treasuries, the DATs. And it's been an explosive growth. So year to date, probably between 15 and 20 billion of total private fundraise of DATs. So there is this thesis to be made around rotation of institutional capital and non-crypto native capital formation from venture capital to sort of ETPs and digital asset treasuries. What's sort of view on this sort of overall trend? Is this sort of there to stay, or will we still see new things coming up? Maybe Joe.
I think if you take a step back, go back to 2018, there was actually tremendous demand from the largest institutions in the world, pension funds, insurance companies, asset managers, sovereign wealth funds, to get exposure to crypto. And by crypto at that point, I really mean Bitcoin, ETH, and stablecoins. There was not a lot of interest beyond that. They just could not own spot. They didn't have custody arrangements. It wasn't within their investment guidelines. So they got proxy exposure through VC. And that led to a massive boom. You can actually suggest that there was too much VC capital floating around then. And we spent, when I was at BlackRock, almost 2 years working with institutions to understand what they were interested in. We worked with the SEC for 18 months. And on January 11th last year, we launched a Bitcoin ETF with 11 other issuers, and in July, an ETH ETF. Why? Because there was institutional demand. They just needed a better wrapper, a wrapper that they had in their portfolio already. And those funds, at least at BlackRock, raised about $105 billion, which shows there was demand. We didn't create the demand. Institutions wanted this exposure. I think the digital asset treasury trend is a smarter exposure, especially in my ecosystem, which is Ether and Ethereum, because the ETFs that I launched at BlackRock, which I think are great vehicles, still don't have permission to stake. And if you're in an asset as a treasurer like ETH, where you can hold it for capital appreciation and you could stake it and earn 3, 4, 5%, if you're not getting that productive compounding yield and you cannot yet in the ETF, it's a superior way to get exposure. But the people are underestimating the demand from institutions. They just need a responsible way to own it.
Any views on that? Like what, why digital assets treasuries were able to take so much share from the other sort of asset classes?
I think you also have to look at, so obviously everything that I say is very focused on Bitcoin because that's what we've built our treasury on. But if you look at Bitcoin as a movement itself, it's quite different in the institutional world, in the normal investing world, in the sense that, retail investors have got this first and the institutions are just starting to understand it. I've just got back from New York. I met with over 12 different fund managers over there, and their knowledge is tiny compared with, my shareholders. We've got the third biggest community on X for a Bitcoin treasury company, probably a digital asset treasury company as well. And the knowledge that the retail market has got is fantastic. So I think that's part of the story as well, in the sense that the institutions are understanding it later, just like they did with Bitcoin and just like they did with other cryptos, I'm sure. And that's quite exciting as well.
Yeah, I would say, first of all, to me, why would someone want to buy our DAB? There are 3 reasons. The first 2 are sort of the standard that these guys did a nice job of covering, which is one, a lot of institutional investors just can't easily get access to spot or whatever. They're not going to buy, worry about custody and all that. And 2, as Joe said, there's things you can do when you own the token directly more than an ETF can, which actually adds up over time. I think both those 2 things are very relevant, and that's, why, in my opinion, DATs do and should trade at a premium. The third thing we have going for us is that Hype, the token in our DAT, which, as I think probably most people here know, is issued by Hyperliquid. It really only trades currently on Hyperliquid. Hyperliquid is not available in the United States. It is not easy for the casual investor to get on. So us putting it in a DAT that's traded on NASDAQ, that's easy for, anybody with a Robinhood account or whatever to own, to me just adds to the already existing reasons that DAT should exist. And, since we announced this, we've talked to lots of people. I've talked to small investors on Twitter, X, and I've also talked to large institutions, people who I wouldn't have believed before I got involved, who told me that they can't trade on a DEX. It's not going to happen. They can only own something like Hyperliquid through a digital asset treasury. And that, is really interesting to me and sort of shows why we're all here, that different people need to own different things in different ways. And crypto is growing and continues to grow to a size where it doesn't have to be one or the other. There's going to be lots of different ways to do similar things.
The other side of the reality is, also has been explosive sort of demand and funding into the space. Into the competition has also really stepped up especially in the recent month. So how do you see sort of the competitive landscape of DATs evolving, both between the assets. I mean, you represent some of the biggest assets in the crypto space, but also within the same assets, you sometimes have multiple DATs actually competing for mind share, for attention, for funding. Yeah, how do you see that evolving, and where are we going from here?
Yeah, I think competition is good. We use the word co-opetition. You both cooperate and you compete, but there's something really positive about having a lot of great minds who have the same thesis. In our case, the thesis is there is a macro multi-decade Ethereum opportunity that is going to fundamentally reorient the rails and the settlement layer of all of finance. And I'm not talking about $4 trillion of crypto. I'm talking about $700 trillion of financial markets that are prime to be fixed in a new paradigm. So having competition means you have a lot of people with the same idea. So I think that's really positive. I think the bigger competition is going to be, ultimately, there's going to be a handful in every category who have liquidity on the NASDAQ. Bitmine and SharpLink have about 98% of the trading liquidity. And if you don't have trading liquidity in your stock, it's going to be very hard to raise capital. I think the second thing is you're seeing a massive entrance down the token market cap of DATs. And my advice is, if you think a DAT is going to change your token price, the number one thing that's going to change your token price is actual business activity, is revenue, is TVL. So I think we're going to see a lot of people reach for the vehicle, but if their underlying is not effectively demonstrating that they're making change and driving revenue, it's very unclear why wrapping it in a DAT structure is the right answer.
What do you use on, maybe Andrew, yeah, Bitcoin ecosystem, there's like plenty of DATs. How do you view the sort of competition in that space? What are the success criteria maybe? Yeah, to differentiate.
Yes, as you say, there are quite a few Bitcoin Treasury companies, probably over 200 on current counts, across the world. What we believe at the Smarter Web Company is that there'll be one at least dominant player in every market. And I think what you will see over the next few years is that the equity story of these things is a global story, but there's a lot of products that we're creating in the future that are locally targeted. So for me, the most exciting thing that we're doing at the moment is we're building effectively financial products based on the Bitcoin network that are designed for different people that have got different objectives. So for example, I like volatility personally. A lot of people don't. They just want a coupon, 8%, let's say. So through the power of Bitcoin, we're able to develop these new products going into the future and offer people returns that they can only get through Bitcoin without taking on the properties of Bitcoin, for example, the volatility. And then the company, the DAT, the Bitcoin Treasury company, whatever you want to call it, then benefits to the tune of the return above the bit that gets shared with the different investors in the different products which are created. So, and a lot of those stories, as you've seen with strategy in the States with the preference share offering, for example, are local stories. So, companies can use their balance sheet and then expose their balance sheet to different types of investors looking for different things, on a global and a local thing. So I think that's one big thing that you'll see as the months and years unfold from here.
David?
Yeah, look, I would say regarding competition, I give my two colleagues here to my right a ton of credit because, they're competing in two absolutely massive assets, be Bitcoin and Ethereum. On the Hyperliquid side, we are by far the biggest DAT out there. We're more than 10 times bigger than the next guy below us. So day one, we're going to compete just on size. And I think that matters a lot for things like liquidity and all the things we talked about here. I think on day two, going forward, we're also going to need to compete on what we do with our tokens and how we are part of the ecosystem in both a positive way for the ecosystem, but also in a profitable way for ourselves, where we're both feeding the ecosystem and making it better, making the whole thing better, but also figuring out a way for us to earn, reasonable returns above the staking yield without any additional real risk. So that's day two, and that's how we can beat day two. But I think look, on one hand, competition is what everyone always worries about in their businesses. On the other hand, what's the expression? Imitation is the highest form of compliment. So I think I have that wrong. But anyway, that's we can't be surprised to see competition, and it generally makes everybody better.
I mean, we've come beyond that first phase of explosive growth, I think already. We're seeing some early signs of exhaustions of like new deities coming into the market, going after the same investors, and then the sort of older, much bigger deities like yourself, like continues to kind of go down that sort of ATM route. Where do you see sort of the future market growth of the total DAT asset class go from here? Where's that growth really going to come from? Is that coming from, as Andrew, you mentioned, maybe going beyond the US into other markets? Is it coming, as Joe, you mentioned, down the risk curve, like smaller altcoins, also doing that? Yeah. What do you think?
I'm really not focused on where DAT growth is. I'm focused on our strategy. And I think every DAT needs to have a strategy beyond just making the price of their underlying go up. And yes, ETH has gone from the low 2000s to 4,000 in the last 4 months. I think people are missing why we're here. We believe there's a long-term Ethereum opportunity. Just look at stablecoins. Stablecoins are about 280 billion in market cap. We believe, as does Secretary Bessent, that it'll be 2 to 3 trillion in stablecoins in the next couple of years. 60% of that is on Ethereum L1 and L2s. Tokenized funds and assets are only about $30 billion. That is minuscule. Most of that is happening on Ethereum, over 80%. And if you look at DeFi, which was built on smart contracts on Ethereum, the high quality liquid DeFi, I'm talking about borrowing, lending, market making, swaps, are happening largely on Ethereum. And if you believe we're at the early innings of massive tokenization and adoption, and I'm not talking about crypto natives, I'm talking about the worlds of finance settling on a new neutral platform, then the value of the underlying token, ETH, is bound to go up very significantly. So to me, it's less of a DAT strategy. It's a belief that the world financial system is going to be running on neutral, programmable, atomic instant settlement rails. And if you believe those rails are your chain, you want to gather as much of the underlying ETH as possible, because when you own 3.5 billion of ETH or 10 billion of ETH or 40 billion of ETH, you can do remarkably positive things in DeFi, and you could be a very benevolent player in driving adoption. So this is not about token value. It's about giving investors a long-term opportunity. And at SharpLink, along with our partners at Consensus, we're going to change finance.
Yeah, I would, share the overall sentiment there. I've lived my life for almost 10 years, not believing in fiat currencies, believing in Bitcoin as the only store of value. So as a company, you probably need to split that down into two areas. So as a company, we have a responsibility to help people, and that might be governments, that might be the legacy media, that might be, even countries, other companies, competitors, everyone understand why Bitcoin is, in our opinion, the best store of value. So that's the thing that we have to do there. But then in terms of what we have to do as a company, why investors think that we can do this better than anyone else. If I look at the last quarter yield that we've delivered to our investors, we've delivered almost 300% Bitcoin per share return over a quarter, 3 months. So that's the thing that we have to do as a Bitcoin treasury company, a digital asset treasury company. And that is us showing our investors why we deserve to exist. So I think, in my opinion, all the companies in the space, they have to do their bit to help their ecosystem, Ethereum, Hyper, whatever you care about. But then on top of that, they have to prove their existence, that they're adding value to the people that are supporting them. That's how I see it.
Yeah, I think with us, because Hyperliquid is much less well known than Bitcoin or Ethereum, it's a little bit of a different story. I don't, even people who don't know much about crypto at all, so I know about Bitcoin, and Ethereum is not far behind. For us, I'm running around having conversation with institutional investors, and I'm saying, let me tell you about Hyperliquid. It's an exchange. It's founded in Singapore less than 3 years ago. It has 11 employees. It's never taken a nickel of outside money. Today, it's running at probably approaching $1.5 billion of free cash flow, and it's using almost all that to buy back this token. And the conversation like that, first you got to explain to them, and people have to believe you because it sounds, almost too good to be true. So you get through all that, and then they say, okay, that sounds great. You've convinced me. How do I buy this token? And then I say, well, you better sit back down. Because that's now another complicated question we have to get into. And that's really where our digital asset treasury comes into. So I think for us, there's a much, earlier or steeper learning curve that has to happen around what Hyperliquid is. But it doesn't take long once you go through some of those key stats I just said, where people say, wow, that's pretty interesting. That's pretty new. And then, it is both an exchange and it's its own L1, layer 1 blockchain. What do you mean by that? How does that work? So again, it's just different enough, both in its recency of success, the size it's gotten to, the small number of employees, and frankly, the difficulty it is for many regular way investors, especially in the United States, to own the token directly.
The reality is the MNAV premiums of a lot of these DLTs have been compressing quite a bit in the last couple of weeks, especially. What does that mean? Is this are we seeing signs, of market saturation or exhaustion? Where do you think the music stops, and how do you actually, prepare against it?
Yeah, so we have a positive MNAV now, but for the short period of time we didn't. We just did the right thing. You don't raise capital. You don't issue equity when your MNAV is less than 1. You dilute. What you do is what we did. We bought back 2 million shares, and that was accretive for investors. I think in the long run, you got to get through some of the FUD and the noise and let the system work itself through. But for a productive asset like Ethereum, if you own $3.5 billion of Ethereum and you can get minimum 3% staking rates, you should have $100 million of revenue. So even if we just stopped today and didn't raise billions more, you're talking about a public company wrapper where you have an underlying that's appreciating, and the revenue should come with a multiple. And you haven't really seen the DATs do a lot of public filings around revenue. We're all reporting what we own. When you start seeing that, I think investors will start rewarding that like you do on any forward revenue and cash flow in a public company. I just think it's a noisy period right now, and I think let it settle, and you'll see the MNAVs come back to reasonable multiples. These things are mean reverting when they're very high, and they're mean reverting when they're very low. But it is nice to have a positive MNAV. It doesn't feel good when you don't, but you always have to do the right thing for investors.
That's a great point. And I want to double down on that point. Some of these DATs will produce operating revenues, right? Whether it's from staking, etc. And that's, I think, not sufficiently appreciated. If we start to value these companies based on these revenues and therefore cash flows, right? Are you already seeing sort of an averaging of like multiples valuation on those operating revenues? Like, is there any correlation? Is it already being given credit for, do you think?
I don't think it's...
Are we too early?
I think it's too early, and I think a lot of these companies, we took over Shell, NASDAQ companies that had legacy operating companies, and I've said publicly, I need to be careful. We're going to build ETH-denominated operating companies, which will be somewhat uncorrelated, and we'll be able to spin up ETH-denominated revenue, and that's a bit of a flywheel. I do think the one interesting thing about running an Ethereum DAT is you have a lot of investors who want the common equity, but you're going to start seeing people issue convertible bonds. And Ethereum is different than Bitcoin. Bitcoin's volatility has come down significantly, maybe because of the ETFs we launched at BlackRock, but ETH still has a 40 volatility. which means if you can get a syndicated convertible bond offering that's high quality with a low coupon, you can earn more in staking than your coupon rate. And it could be very, very accretive to shareholders because you get to raise capital and your native staking will cover your debt. And when it has high vol, it's very attractive for people who want that type of convertible bond strategy. And there's a lot of interest in Wall Street in that volatility while having the safety of staking yields covering your debt ratio.
So maybe do you think there is a world where today DATs are valued fundamentally based on some kind of MNAV premium or discount to the underlying crypto asset, right? But do you see a world in future where DATs can and will be, maybe partially or wholly, be valued based on multiples of the operating cash flow or the revenues?
I think if you look at what institutional investors are seeing at the moment, they're only starting to understand the model. Yes, we've had strategy for 5.5 years, we've had Metaplanet for 18 months. Interestingly, Metaplanet, I think that sets a good example to everyone that's interested in the space, and in the sense that they've actually had 4 cycles of MNAV compression in a year and a half. So if we see what's happened this year in my company just being listed, 5 months ago, lots of these other companies also getting listed. It's so early this time to look at it. We have to, we have to expect that these things are going to be, expensive if that's the right word, and cheap if that's the right word at different times, whilst we all try our best to help everyone understand these new metrics. We did some research. So somebody who works for me called Jesse Myers, who wrote the research or part of the research that MicroStrategy, now called Strategy, was based on, which is the asset landscape view, gold, Bitcoin, equity, debt, etc., etc. It's all in all of Saylor's slides. And I think that people are only just starting to understand all of this stuff, and as time progresses from here, the understanding will get better. So we created this thing, which is like, we've called it PBYD, which is like an alternative for digital asset treasury strategies, how you can value them in a traditional equity way that may be, like a PE ratio. That's on our website. If you want to go to our investor relations website, you can read that. It's all published. And that's trying to get investors to understand how you can see the yield that we create and view it more like traditional revenue that a Nvidia or an Apple or someone like that would create, that's measured in a PE. So it's just taking time and getting everyone to understand we're so early with all of this.
Yeah, I would make 2 points. One, I would say, for all the reasons that we're discussing here, I think over time, we're going to settle to a situation where on a weighted average basis for all the DATs out there, which is where we are now, of course, but they're all trading at some premium to MNAV. Now, not every single one of them is going to trade at a premium, but the weighted average for everyone is going to be some premium for all the reasons we're talking about. And I think that to answer your question, analysts will start figuring out how to break down that premium between, scarcity value and between, difficulty to hold or whatever, and between some PE multiple on earnings. And that people will start doing a more sort of thorough quantitative analysis of what the MNAV really means and why it's different among different people when, as I said, the average will be above 1. The second point I'll make, and I don't mean to keep coming back to a theme here, but as you'd expect, I believe that whatever that average is, we're going to trade higher than that. And we're going to trade higher than that because our scarcity value is still so much higher than everybody else's. Again, I don't know how many people in this audience own Hype right now, but everyone in this audience is pretty damn, crypto knowledgeable. And even for people here, it's a lot trickier than buying some Bitcoin in a Coinbase account. It's just totally different. So again, I think the MNAVs on average will be there. I don't think everyone will be, for lots of reasons. I think one thing we haven't talked about a lot today, but you can't forget, is that once you put something in a corporate entity, you have revenue, as we're discussing, and revenue is all good, but you also have expenses. And someone's got to pay for those expenses. And to the extent, particularly some of the smaller ones of these DATs, have expenses that are outweighing the revenues, you're going to have a real drag there. And that's going to cause a real drag on the MNAV. And again, as time goes on, as more of these are out there, as there's more quantitative analysis around MNAVs, you're going to see people really trying to understand why different ones trade at different levels, and again, over time for for logical reasons.
Let's fast forward maybe 12 months from now. There's a likely scenario where we will enter sort of a crypto bear market again, and Bitcoin maybe draws down 40, 50, 60%, and altcoins even more. What happens with the DATs, and how do you actually, as sort of the leadership of these DATs today, as we actually prepare or like risk manage against these kind of things? Let's just play out, right? Like prices go down, forced liquidations, there's consolidation happening in the market, M&A is happening. There may be like activist actions, right? And on the board level, the overall sentiment goes down by a lot, right? What can you do? What can you do already now to prepare?
Well, I think you could do 2 or 3 things. One is, don't put yourself in a position where you have a forced liquidation. We have no debt on our balance sheet, and I would expect when we do raise convertible, it won't be secured by our ETH. So if you own ETH or you own an ETH DAT, yes, when the value of the underlying goes up, my stock price will go up. It's expected when the value of the underlying price goes down, and that will happen in cycles, my stock will go down, but that does not force me to liquidate. In fact, if you believe there's a decade-long opportunity, that is a great time to buy more of the underlying. And I think investors will understand that. Second is, we've chosen going forward largely to build these capabilities on team. You have some DATs that are composed of 3 or 4 people, and they've just essentially outsourced management and are willing to pay others 1% to 2% of NAV to acquire the underlying assets, stake it. We're going to be building, and we are building that capability because it's a lot better for shareholders if you could do it yourself, retain the talent, and not pay the external advisors 1% to 2% of NAV, when, by the way, you may only be earning 3% yield on those assets. So we're going to do it the smart way, and we're not going to do silly things. I think what you will see in this industry, and we've seen it in every cycle, is people will go out and take risks to try to catch up. They'll either take on bad debt, they'll start staking and swinging for the fences and not think about the risks associated with that. And that is quite dangerous. And I think it'll differentiate those who are run institutionally with those who don't have the capability to do that in a risk-managed way.
So from my side of things, I set up the Smarter Web company 15 years ago. I'm incredibly proud of it. We've got a small, operating business that contributes revenue to the company, nothing to do with our Bitcoin Treasury strategy. And, you've got to have a strategy, if you want your business to exist for multiple decades into the future and do the mission that we're, trying to progress, you've got to have a strategy that caters for those times. If I look back to when Bitcoin started, which was the same year that we actually founded the business, so 16 years ago, if you've got a long enough time scale and you've picked the right asset, which of course we believe is Bitcoin, then, dips are no big issue as long as you've got your capital structure right and you've got a company like ours with, no real debt, operating income, et cetera, et cetera. So I think, in that scenario, you'll see the things that have been built on the wrong assets or with the wrong structures. And, that's what you as an investor need to be careful to avoid, I would suggest.
Yeah, look, I would say, like every good economist, I can predict everything except timing. There will be a bear market again in crypto, of course. I don't know when it's going to be here. I don't know how long it's going to last. That will probably move MNAVs as well on the DATs, because of course it does. One of the reasons I think that MNAVs over the long term will be positive premiums is that, as Joe said earlier, when the premium's high, you issue equity, you accrete your book value. If the premium goes negative or really negative, you have to do what's best for your shareholders, which means you're going to buy back your stock, which also accretes book value. So, be staying flexible, meaning agree with Joe also, and not having debt that could carry you out. Staying flexible, and the long-term goal is to grow book value per share as much as possible for your shareholders. And I think through cycles, DATs can do that in different ways.
Okay, final closing statements, 1 or 2 sentences, prediction of where DATs will go in 3 years.
I don't have any predictions on DATs. I know finance, which is gigantic, is going to come to decentralized rails. And I think people are underestimating how exponential growth happens. You always underestimate that on the upside. And I think we're in the early innings of seeing most of financial services, money movements, funds will exist in digital format. And we won't be using the word crypto. We'll be talking about the digitization of financial worlds.
And
For me, I think over the next 3 years, you'll see the Smarter Web company go from, in the UK, almost one of the biggest 350 companies to, let's say one of the biggest 100 companies. And more importantly than that, globally, I think you'll see digital asset treasury companies well on their way to becoming the most valuable sector in equity markets globally. And within probably 10 years, I think you'll see that the most valuable companies in every equity market will be digital asset treasury companies, probably Bitcoin ones as well.
very bullish, very bullish. David?
We're long past time, so I'm going to summarize with one word: Hyperliquid.
Okay, thank you very much for your time.